This series of the 50 Faces podcast is proudly brought to you by B Finance, a trusted partner to the world's leading institutional investors. With a proven track record in strategy, implementation, and oversight, B Finance delivers bespoke investment consultancy that empowers asset owners to achieve their unique objectives. For this episode, we're going to have a special treat as we're bringing you an episode from the Alvine Talks podcast, which I co-host occasionally with the founder of Alvine Capital, Tom Raber. In this podcast, we speak with Bjorn Thelander, a longtime friend and contact of Tom's, who was formerly Chief Investment Officer at the Dyson Family Office based in London. I hope you enjoy the discussion. I'm Ethan Devitt.
And I'm Tom Raber.
And welcome to this Alvine Talks podcast, in which we chat with allocators and thinkers across the world of investment and bring them some Alvine level debate.
We are joined today by Björn Thelander, who is an experienced family office manager with a broad international investment and industrial background. Most recently, he was the CIO of one of the largest family offices in London. Before that, he's had several jobs within other industries, including a large industrial concern with a Nordic background. He is educated in Sweden, the US, and Australia. He, aside from being a great friend and a very good investment professional, he's a very interesting person who has many broad interests, including golf, skiing, swimming. He currently resides in Switzerland.
Well, Tom is obviously a long-term friend of yours. I'm new to meeting you, so I'd love, for the benefit of me and our listeners, if you could start with charting your background and your path into the investment world.
Sure, Ethan. Well, first of all, I'm delighted to be here and talking to you both, and nice to meet you, Ethan. Yeah, so my background is really, my parents were Swedish and they moved to Australia in the early 60s, and I was born and raised in Sydney. Grew up there doing lots of sports and moved then back to Sweden in 1976 when I was 12. Went to high school, military service in Sweden, and then studied mechanical engineering. And then I started my working career, which was for ASEA Brown Boveri in Ludvika, of all places. And they then sent me on my first expat assignment, which was to Brazil, which was a fantastic place, loved it. But I kind of realized that the more important decisions were taken by people who had a business degree. So I decided I should also get one and apply to a couple of business schools. And off I went to California to a place called UC Davis, to the Graduate School of Management.
And then just to compress the story a little from your MBA at UC Davis, your career then saw you in multiple emerging markets, from Mexico to Singapore, back to more conventional ones such as Switzerland. It spanned working in industry, investment banking, investment management, family offices, an entrepreneurial spell, and then back into a family office most recently. And one thing that really strikes me is not only how much emerging market content there is there, and we'll certainly ask you later about how emerging markets affected your psyche and your approach to investing both there as well as in other markets and risk, but also many of these experiences were punctuated by crises. And I know that all three of us here have had much experience investing through crises, so we'll talk a little bit about that. I think it's great to move on to your investment philosophy now, and I'll pass it back to Tom to sort of dig into some of those principles.
Yes, thank you, Ethan. No, I just want to ask you, if we talk about your last job, a large London-based family office, and we know many of them, of course, do you feel that the structure you had there and the investment team that you had, was that the right setup to approach the markets, and did it achieve its objectives?
Well, so the two last jobs I had were both very typical sort of Yale endowment style strategies, sort of multi-asset class, a lot of private markets. And yes, I think that that model is still very relevant. However, I think it's only for family offices with the level of, first of all, of AUM and the level of sophistication. Because what's necessary is that you have sort of the requisite amount of expertise and experience to do the manager selection, particularly in the private market asset class, but even also in the other alternative asset classes such as hedge funds. It's nothing for a two men and a dog to do. So I'd say that you need to have a relatively large and sophisticated family office to do that. But for those who do have that, I think it's still very relevant. However, my own sort of personal belief is that the sort of outperformance that you've seen in private markets, private equity and venture capital vis-a-vis public markets is sort of bound to shrink, so to speak. And this illiquidity premium that you're after in sort of committing your capital to private markets is shrinking over time.
Okay, thank you, Bjorn. I want to ask you, Ethan asked about various crises that have taken place in the markets, and we've been through them, many of us. We're now at a situation where all the markets are at an all-time high. We have a new president in the United States. The markets jumped significantly overnight. Everyone saw the Trump, well, not everyone, but the Trump trade really did work for the people that had it on. I know we're not here to predict the markets as such, but what's your view on the markets at the current level, and how would you position yourself for the next, call it 12 months?
Yeah, it's interesting. I think we're obviously at very elevated levels, particularly in the US and particularly within sort of technology. And, I think it's the top 10 companies are now almost a third of the S&P 500, for instance. So this level of concentration is very unusual. And I don't know if your listeners to the podcast saw the recent Goldman Sachs report. I think it was David Costin who wrote it, predicting a 3% annualized performance of the S&P 500 over the next 10 years, based, among other things, on this concentration factor, which they sort of hadn't had in before. But, it's clear that the valuation is very high. If you look at the cyclically adjusted PE ratio, for instance, it's at 38, I believe, for the S&P 500, which is in the top 97th percentile. So I would say that all of that indicates that the sort of equity risk premium is going to be lower over the next 10 years than what it has been over the past 10 years. Having said that, I think there are definitely sort of pockets of the market, of the global public equity market, that are interesting. And I think that the sort of the marginal dollar that people will invest might go to other markets that are, deemed to be more value, where either the valuations are lower or currencies are more beaten up. But right now, there's no doubt that the US is still the most dynamic, deep, energy-filled market in the world. So personally, I think it's correct to have a significant chunk, if not a majority, of your equity exposure in the US still.
Well, taking it outside the US, I just go back to my original question about all of that very early and consistent emerging market experience that you had throughout your career. How do you think that shaped you as an investor and your attitude to risk?
Yeah, that's a good question. As you said, I was in Brazil when they had 90% inflation a month. While I was there, they changed currency 3 times. And of course, when I was in Mexico, the Mexican peso lost 60% of its value. It follows me around. But yeah, I think that it has shaped my thinking in the sense that we humans, we are prone to herd behavior and to overreacting. And over longer periods of time, markets tend to be rational, but in the moment, they can be very irrational. And I think that's a brilliant opportunity to make money, basically, to exploit the other side of that issue. I've had not a lot of money, but in Argentina, believe it or not, just through there's a MSCI Argentina, ARGT, I think it is, for a while, where I think that there's something that has shaped me a lot, and more actually, the sort of the political and geopolitical situation in terms of bottom-up stock picking and evaluating different markets. And I can also recommend a good podcast on the Meb Faber Show with Rob Citron, who's been a very big proponent of Argentina and knows President Milei very well. So, and I'm also a big fan of Milei's, I have to say, and the experiment that's going on there. And I wish him much success. But yeah, definitely, I think you have to be aware of the different risks you're taking as you go into frontier markets or emerging markets. But when you pick them correctly, the sort of the turning points, when things start improving, even if it's from a low base, you can make a lot of money. That's for sure.
It's interesting, just to follow on that thread before passing back to Tom, with the 15-year underperformance of emerging markets versus developed markets, and the US in particular, it obviously becomes increasingly difficult to make that case. What would you think is the kind of ideal allocation to emerging markets in a typical family office portfolio that doesn't have perhaps a particular interest in a country for various reasons? Do you think emerging markets belongs as a long-term holding?
Absolutely. But let's say a typical endowment portfolio, you might have between 35 and 50% public equity exposure. I'd say of that, you should probably have at least 10% somewhere in emerging markets. So say between 3.5% and 5% at least on the overall portfolio, if you're talking about a large institutional portfolio. So obviously you don't want to bet the farm on it, but you should definitely have exposure to that. I mean, what I did in some previous jobs was that we had 80% of our equity exposure, public equity exposure, in a passive sort of acqui type of index tracking instrument at very, very low cost. And that, of course, does include a lot of emerging markets, although, personally, I've been quite anti-China. And of course, China is a big chunk of that emerging market exposure in the passive indices. So I would be perhaps more selective. Or if you find a good active manager that can sort of play the different emerging markets in a successful way, I think that's also a way to do it.
Thank you, Bjorn. In terms of that, we've got two themes there. Could we touch on maybe a third? I know crypto has been an area you have been quite active in, at least on a personal level, quite some time. Could you give us your views on that, please?
Yeah, I mean, I do believe that we're in a period of very substantial fiat currency debasement. Not only that, but also weakening trust in various institutions and central banks. And therefore, the tendency is for governments and central banks to print their way out of issues by throwing money at different problems. The problem with this is that these government deficits and debt to GDP ratios become unsustainable. And so what is the answer to that is to create inflation and to keep printing, basically. And therefore, my view is that a lot of the assets that we invest in traditionally in financial assets, equities, bonds, etc., nominally they might go up, but in real terms, in terms of real purchasing power, I think you have to account for the increase in money supply. So in that sense, I'm very much along the lines of Milton Friedman and the monetarists. So I believe very much in investing in things that have scarcity value. And I think, so in that include both gold, for instance, and Bitcoin and Ethereum. I mean, personally, I have a substantial amount of my own sort of personal investments in crypto, in Bitcoin and in Ethereum, because I believe that that sort of scarcity value and the fact that it's completely decentralized and cannot be affected by governments or central banks, I think is a very valuable trait.
Right. And we wanted to ask you in terms of artificial intelligence and AI, what's your view on to what extent that's going to have an impact on the investment landscape and also as an investment manager, how you use the tools that are available? And did you indeed use them already in your previous jobs?
Yeah, if we start with, I think this is very beneficial to many industries in terms of using AI just to improve across the board, whether it's online help functions or analysis of new molecules in pharma. So, I mean, AI is a complete game changer, and I think it will, over time, increase productivity and growth and help us with a lot of issues that the whole world is grappling with at the moment. In terms of whether I think it is being used or should be used in terms of selecting financial instruments, absolutely. Do I think that it can be a magic bullet solution to doing that? No, I don't think so. I think the collaboration between human managers and the instinct that comes with having managing money for a long time and AI, I think is probably the most powerful thing. And, I happen to be involved with a company that does basically sort of algorithmic stock picking, where we are starting to use AI in terms of analyzing not just the fundamentals and the bottom-up P&L and annual statements of the companies, but also, for instance, the management transcripts, management discussion analysis on a quarterly basis to increase the hit rate and being able to predict stock prices going forward. And so, I mean, the potential of AI is just unbelievable. It's off the charts. And even with the sort of the research that we've done on that side has increased our sort of hit ratio of selecting the right stocks substantially. And obviously, I've spoken to a lot of the large tech hedge funds, Philip Lafont at Cotu, for instance, and they're putting lots of resources into this as well. In a sense, it is kind of an arms race. But then again, the investment universe across all these different instruments, across all these companies, is so vast. It is still easy to find sort of pockets or areas of investable instruments where there is a lot of alpha, where you can definitely take advantage of AI to gain an edge, an information edge.
It's really interesting. I think there's also an aspect to investing that maybe is the opposite to everything you mentioned, and it gets back to a topic we mentioned earlier around the Yale model. I know people think of the Yale model often as a high allocation to alternatives, to illiquid assets, the endowment model. But I've had various presentations by Ashby Monk, who has spent some time studying the Yale model from his vantage point there at Stanford. And he actually suggests that the Yale model is more the way that David Swensen did business, which was through building deep relationships with his managers and letting those relationships develop over time and be sustained over time, so that you really end up in a series of strategic partnerships. And I suppose some form of partnership, as well as this AI-aided number crunching, could well be the magic formula. What do you think of as being the Yale model, and do you think it's still relevant today?
Yeah, that's a good question. And I agree with you. I think that if you study what David Swensen did at Yale, it was absolutely a question of creating these deep relationships with alternative managers that at the time could easily annualize 20, 30% a year. And so I think a lot of that is more difficult today just because alternatives are not as inefficient as they once were. So if you look at the Yale model, you do your back testing across all of the different various asset classes that you have, and you look at what the risk-adjusted performance is, and you sort of have those building blocks, and you can look at it from a beta perspective or beta equivalent perspective of, say, bonds, of equities, of liquid credit, etc. And you can sort of build up what you expect the beta component of the returns to be. And that was sort of what we did in the two jobs I had. But then on top of that, then you expect the managers that you choose to produce some kind of alpha in each asset class. And sometimes you get that and sometimes you don't. But even without that, you can normally, just by adding these sort of risk premiums together, manage to achieve something that I think over time, and because in an endowment model, your overall sort of risk exposure is relatively static. It varies up and down a little bit. And of course, underlying all of this basically is the equity risk premium. So over time, equities have done better than inflation and have done better than bonds. Every time you can get some alpha in addition to the sort of the beta exposure or the beta load per asset class, then you should be able to do reasonably well. So, I mean, a typical endowment style investment objective might be CPI plus 3, 4, or 5% or so. And that will determine how much of the more riskier asset classes you need, whether it's private equity or venture capital or public equity. And of course, the more risk you take on, the more variability around those returns you'll get as well. But as I mentioned before, I still think that for a lot of larger, more sophisticated family offices, it is still relevant. Although, as I also mentioned, I think that the sort of illiquidity premium is shrinking.
Well, thank you, Bjorn. There were lots of insights there on your view of the markets and investments and where we are currently. Thank you very much. I think it's important we move on, and we wanted to ask you a little bit about your life outside investments. So we know you have a lot of different interests, but if somebody asks you what makes you tick, Bjorn, how would you answer? And please give us an insight.
Well, yeah, I have to admit I'm quite competitive. I do a lot of sports, both individual and team sports. I love hanging out with my friends. My family, all my children are diehard backgammon and chess players. And, I play a lot of paddle tennis and golf and so forth. So, yeah, outdoors, social life, just trying to enjoy life as much as possible, I think is really important. We never know how long we can have our health or we have the people we love around us. So I think it's really important to try to do as much as possible.
So do you feel that in the investment industry, some people actually do work too much, don't take enough time off, and don't really recharge their batteries? I mean, this constantly, I've got to be in the office, I'm so important, running from one meeting to another, et cetera, et cetera. Does that really make any sense?
I think that's very much the case, particularly in New York, if I may say. I've been there many, many times over my career and spent quite a bit of time with a lot of managers there. And they seem to take pride in how little time they are outside the office. And for me personally, I think that's just a darn shame because we only get one shot at it. And, life is much richer than that and much more important to, the social aspect. And at the end of the day, how much money do you need? What's important are, friendships and relationships to me. So I think, it's less so in Europe. But yeah, I've definitely seen some cases of people working too much in Europe as well, in London.
Well, a nice philosophy of balance there. Our last question would be, if you were to sum up some of this advice, these learnings, this wisdom, and give advice to your younger self, to that young worker who is going out to Brazil for the first time, experiencing the working world for the first time, anything you know now that you wish you had known then?
Well, yeah, I mean, I've made so many mistakes in my life, but one of them is just keeping an open mind and be humble. If you're wrong, admit it. Don't be too stubborn. Try to think outside the box. I think lateral thinking is incredibly important. Treat other people with respect. Surround yourself with the right people. Yeah, I think work hard, I think a proper work ethic and treating people decently, you can get pretty far on that, and having integrity.
Very good, Bjorn. Finally, what book have you read recently or any time in your life? And what is it that makes that book so worthwhile, and why do you recommend it?
So I always read several books in parallel, depending on what mood I'm in. And some of them are more work-related and some of them are more just for fun. I'm actually rereading an old Swedish classic called Red Orm, which is by an author called Frans Gebanks. I think it's called The Long Ships in English. It's about the Viking times around 980 to 1020 under King Harald's time. It's it's very humoristically written. That's one book I'm actually reading. I'm also reading Anthony Beevor's tome about the Second World War. I think he's an excellent historian. Matt Syed's Black Box Thinking. So, anything that just stimulates your thought process is... I actually read another really interesting one recently by Ken Follett. I can't remember the title now, but it was about how World War III breaks out, about how the dominoes start falling, and one misunderstanding leads to another. And the book leads to total annihilation and thermonuclear war, which is pretty... But, and the parallels to the First World War in 1914 are pretty stunning. I wish I remembered the title of the book now, but...
I think it's World Without End.
Sorry?
World Without End.
Is that it? Okay.
Yeah.
It's possible that's it. It was a very sobering read, I have to say. It made me a little bit depressed, but it is, we live in very different geopolitical times, and I'm afraid that we're just at sort of an end of a cycle, which is very chaotic. And unfortunately, it's probably bound to get worse before it gets better.
Bjorn, well, thank you very much. It's been a pleasure speaking to you today. Thank you for sharing your insight with us, and we look forward to seeing you soon.
Thank you.
My pleasure. Thank you very nice. And great to meet you, Javier.
So I found that fascinating, particularly his insights around emerging markets and his high conviction position in Argentina. I have to say that's the first time I've heard that probably in about 20 years.
I know that was a bit of a surprise on the left field. And it's good and refreshing to speak to somebody who does constantly have new ideas in his head. And that is, of course, the very interesting thing with Bjorn, who I've known for a very long time. He knows what the mainstream ideas are, but he's always got other ideas as well. And he's very open to doing what other people wouldn't even consider. And that makes him obviously a very interesting investor and very successful investor over many, many years.
And I also think his forward-thinking approach to AI and to crypto, he has put some of these technologies to the test. And it'll be interesting to see how we embrace them going forward to add alpha into our portfolios. But equally, that we will never lose sight, it seems, of that human touch.
Correct. Absolutely. No, I think that is right. I mean, it's an aid. It's not a solution to all our issues. And I think that's very important to differentiate the two. And the other thing I wanted to add is, and of course I know this from other discussions, is of course the way he looks at so many other asset classes that we didn't have time to discuss today. I mean, he's all over the place, and it all comes down to one thing: how do we add alpha to the portfolio? And he's done it, as we said many times, very successfully. So very interesting to hear his views.
Thanks, Tom. We'll close it out. Thank you for listening to the Alvine Talks podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, you can subscribe on Apple Podcasts or wherever you get your podcasts.
Thank you.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.